Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, macbethgroup.com. Welcome back to the show, Hilliard.
Nice to be talking to you again.
Home Capital, is this going to drag down the big Canadian banks, or are they well-funded and don't have to worry about it?
So they have a different business model at Home Capital versus, say, the Royal Bank or TD. Home Capital has, and this is causing them a lot of problems right now, they have some deposits, and of course the problem with deposits are they generally have the ability to pull their money out in short notice. But Home Capital really depends more on being able to originate mortgages and sell them. So, for instance, they're originating like $7 billion a year, but they only have 15 to 18 billion of mortgages on their balance sheet. So they need funding to do that. They need funding to originate the mortgages, and they certainly need to originate a lot of mortgages in order to make their business model work. And I don't think that they're going to be able to continue much longer because they just won't be able to attract the funding. Now, the difference with the banks is they have this very stable deposit base where people are much less likely to get panicked and spooked and pull their money out. And the banks also have a huge amount of retained earnings and profits and other ways to raise money. So the banks also have the ability to create money when they expand their loans, which the Home Capital people don't have much capacity to do. So they're very different. On the other hand, the similarities are that the banks generally are pretty dependent on the average household in Canada increasing their debt load, and that of course is mostly related to real estate. I mean, you and I have talked before about this. If you go into a bank and say, hey, I want to start up a new company, we got a great business idea, good luck getting a loan. But if you go into the bank and say, hey, I've got this house and I get a clear title and it's worth $500,000, could I borrow $400,000? You'll be welcomed with open arms. So most of the bank lending is related to real estate, of course, even some of the lending that's in the business category. So if the Home Capitals of the world can't fund the mortgages anymore, and if their customers are the ones that are probably the most aggressive speculators, and if they aren't able to speculate anymore and the house prices drop as a result, because every hot housing market needs more and more new money coming in all the time, then it would spread to the banks. Not that the banks would get into trouble like Home Capital is, but that their profits would slow down because they are very dependent on households borrowing more and more money. And at some point, my thesis has been, since the book came out a little more than 2 years ago, at some point the Canadian households will either be forced to stop going deeper and deeper into debt, or or less likely they will be all of a sudden wake up and decide it's a bad idea to keep going deeper and deeper into debt. So if any of those things happen, the bank's profit model will be hurt, and their rate of increase of earnings will slow down, their rate of increase of dividends will slow down, and their stock price multiple, which is they attract a very premium multiple in the stock market at this time, that will probably start to erode compared to other banks in the world.
Now, people who have mortgages at Home Capital, what would happen if the company went under?
Well, that is a very interesting question, and the short answer is I don't know. The longer answer is I can try and guess a little bit. So I mentioned that they originate a lot of mortgages compared to the total number of mortgages they keep, and one of the things that's different about Home Capital is they generally the mortgages are shorter term. They're only 1 or 2 years, so there's going to be a lot of people looking for renewals. And if some of the problems that Home Capital have had are related to mortgage fraud, primarily related to people lying about the incomes they have in order to get a bigger mortgage, and they're unable, if Home Capital can't raise the deposits, which I think looks like that's what's going to happen, when that mortgage comes up for renewal, they'll have to look elsewhere. And now that this has happened, or even before this happened, but especially now, the other lenders are going to be very vigilant about making sure that the incomes are actually verified. You know, it's amazing to me, but apparently it isn't actually mandatory that people show up with a T4 slip, or people actually, or the lender actually phones the employer and says, "Do you have an employee say so and so?" And then the next question would be, they say that they work there, they say that they have this job, and they say that the income, and you don't have to say the specific income, but you say that the range of income is between 75 and 100,000 for that job or something like that, and then the employer would confirm that. Apparently, they haven't been doing that, and it's just shocking to me. But most other countries and jurisdictions, the lenders do that. In fact, I've been told in the U.S. now it's so hard to get a mortgage. You have to show up with your financial records going back 10 years. And so if Home Capital was kind of specializing in that and not maybe diligently checking the records, and then those same people go and try and apply to a different lender, they're going to be in for a shock, because they're obviously the much stricter requirements will be applied. And also, there's just a general, the changes that came out last fall that you and I've talked to about in the past relating to CMHC rules and CRA, there's a crackdown on people flipping homes and not paying the tax on it. All of those things combined, it could be a really tough thing for people to try and switch to a different lender. I'm pretty sure that alone is enough to really change the housing market in the hot markets like Toronto and Vancouver.
Now, if you had money deposited there, you're protected by depositors' insurance, aren't you?
Yeah, CDIC up to $100,000 per account. So some people might have more than $100,000, and like the interest rate you can get at Home Trust, one of the subsidiaries of Home Capital, or they have a different one called Oaken Financial. They're quite a bit higher than the interest rates you can get at other places, but for the trouble, it isn't probably worth it. You're looking at difference between 1.5% and 2%, for example. So you get 0.5% more. But what if they go under? Your money might be frozen for a while. I don't know. I actually don't know how CDIC will handle it. Whether they write the people a check right away, but you would eventually get your money. And you can actually have multiple accounts, and so a couple could have several accounts each, and depending on how it's set up, you have to be careful to do it right. But you could get multiple accounts, but and still get 100,000 times the multiple on each account. But the safer way to do it would be to spread it. I don't know how many people out there actually have more than 100,000 in deposits. Probably not that many, but the people that do have that much probably spread it among different institutions, and that makes it even more assured that you're going to get the CDIC insurance on each account.
Yeah, I think you're absolutely right when you said you'll eventually get your money, but it could be frozen for a long time, and that's probably why people are taking their cash out now.
I think so. Actually, you may have seen this. Some of your listeners, I'm sure, have. But I was watching, I think, the hockey playoffs last night, and an ad popped up for CDIC insurance. It was quite amazing. I've never seen that before. So obviously, there is a lot of concern out there, and will it spread? Going back to your original question, will it spread to the banks? I don't really think that people are going to actually get worried about the safety of their deposits in a bank. But given that most Canadian households don't have deposits, they have debts, it's really, the bigger concern, I think, for the banking system and for all of us is what happens to the economy if, people that have been borrowing sort of at the rate of a 5% growth per year, all of a sudden decide to start paying down loans at the rate of, say, even 1 or 2% per year. The swing from, 5% more each year to, say, 2% less each year is a 7% swing. Is going to be very difficult for the economy to absorb because a lot of those transactions whether it be a new car in Alberta, a new truck in Alberta, or a new house in Mississauga or something. It's just going to make all the difference to that marginal. So there'll be a lot of car dealers and a lot of home builders that'll be struggling to find enough people to sell their products. If people decided that going deeper and deeper into debt is no longer a good idea.
We'll have more with Hilliard MacBeth right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, what about the demographic elephant in the room here? Stats Canada telling us now we have more seniors than children. Don't seniors tend to sell their house and perhaps buy the last car that they think they're going to need until, the great beyond?
I definitely on the second one, I've heard that from many clients. So one of the things that happens in my industry, so I started when I was 29 and now I'm in my 60s. So when you start in the investment business when you're 29, you don't look for other 29-year-olds because they don't have any money, or at least they don't have enough money to make good clients. So you end up trying to, and of course they don't give you any clients when you start. You have to go out and find clients. So you start out and you're looking for 39, 49, 59-year-olds to become clients. And so the advantage of that, though, is as you go through your career, I'm in my 39th year, I've seen all of these people that are older than me go through all the stages before I get to them myself, and definitely the rate of consumption slows down dramatically. In fact, especially with retirement, people, they might spend a little bit of money renovating their house to make it suitable for what they want, and they might buy a car, but they become much more cautious about their spending. And of course everybody's seen the houses of people that are in their 80s, and none of the things that normally you would do with a house to keep it, the upkeep and the maintenance and the renovations, for the last few years, none of it's done. They just stopped doing anything, even though they might have millions of dollars in the bank. So that is definitely true. It's a big change, and it is what they call a marginal propensity to consume changes as life goes by. I have talked to a number of seniors about the value that they have, the equity they have in their home, and the limited amount of income they have to fund their retirement, and suggested that one way to fix it in one simple move would be to sell the home and go to a rental accommodation and invest the difference and live off the income. And because the equity in the home doesn't provide any income, but people are very reluctant to do that. So the trend towards selling is not as, at least in my experience, it's not as great as you might think. It makes a lot of financial sense, but emotionally it's very difficult for them to.
I also understand the reluctance to rent because you can be evicted any time.
Well, the younger people and older people, everybody's told me that if you're renting, the landlord could just throw you out at any moment. Like, you could come home, which isn't necessarily true. I did some research in Germany, because in Germany, more than 60% of the people rent, as opposed to only 30% of the people in Canada. And they have very strict laws that the landlord has to give tons of notice, like a year or two notice, and even then he has to have a good reason. And the sale of the building, which is the thing I hear the most, isn't a reason to evict people at all. So the new buyer of the building has to honor the agreements with the tenants. So
no such thing here, though.
there doesn't seem to be much protection here. I'm sure it's coming. I think in the past we had more protection than we have. You know, the lobbyists have actually, I guess, managed to convince the government that rent controls are a bad idea and tenant protection are a bad idea. But for sure it'll come back, I think, to some degree. But the other thing, even that aside, if you're a landlord and certainly it's happening in Edmonton and Calgary right now, good tenants are pretty scarce, so the landlord will bend over backwards and do anything that he or she can to keep a good tenant. And usually the elderly people are really good tenants. They pay their bills on time and they don't cause any trouble, no wild parties, no Hells Angels bikers parties or anything like that. I think the fear of losing control, which is the thing, really when you probe and ask them, that's what it comes down to, is losing control, is overdone. But the other thing that happens, and this is a study that I found quoted in my book, as people get up past 65, they're sellers for other reasons. Death is one. They move in with their kids if they're short of money. They move to nursing homes and seniors' homes. All of that means that there's going to be a significant shedding of ownership of real estate by older people. And all you have to do is, we live in a mature neighborhood ourselves, and if you look up and down the street, one big home is empty because both people died. It's up for sale, but there's no buyers. It would need a ton of work. It's a big house. It needs a ton of work. Another one, the guy died, and it's currently rented out. There's another one with a single person, older woman living in it, that's going to come available. So there's lots of housing that is going to turn over in the next 10, 20 years because people have gotten older. And the big question is, who's going to buy it? Because of this obsession with real estate and the fear of missing out, most of the young people have already bought. I know people that have helped their kids buy houses before they even have jobs. They're still living in the basement of their parents' home, and they've already bought a house, and they don't even have a job yet, other than maybe Starbucks or something. This pool of new buyers is pretty small, and the pool of sellers that will be forced to sell or their estates will sell, it's pretty big. So the shift is going to be very difficult, and it means that house prices are going to, they'll be under quite a bit of pressure for the next 10 years or so as the average age of the population gets older and older.
We'll have more with Hilliard MacBeth right after this.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Hilliard MacBeth. Hilliard, looking at the equity markets now. The U.S. equity market holds what, 53% of the investments in the world?
The value of all the investments in the world on all of the stock markets, 53% in the U.S. And I look back to more than 100 years ago, and it was only 15% back then. So over the last 117 years, whatever it is, the proportion in the U.S. stock market has gone up exponentially. And some of the countries like the United Kingdom, Germany, and France used to have big percentages, but none of them do anymore. So the 53 is the U.S., and then the next biggest one is like 8% or something like that. So, but even more interesting is that there's 3 companies in the U.S. in the S&P 500 that hold a significant amount of the value and of course they're all technology companies. So it's really a concentrated market. It happened once before in the 1960s and the 70s, where there was this trend called the Nifty 50, and one of the leading stocks was Xerox, for example, and that everybody decided, all the mutual funds, all the investors decided that you could buy these. They call them one decision stocks. You could just put all your money into a very small number of stocks, and of course that worked out really badly. in a coincidence, perhaps, that the bear market that followed after that Nifty 50 obsession ended in about December 1974, and that was just after Richard Nixon was going to be impeached, and he resigned. I think he had so much pride he didn't want to be impeached, so he resigned when he realized he would be impeached because of Watergate. So the bear market in stocks at that time was about 25%, but the Nifty 50 stocks went down about 75%. So the three stocks today that are in that category are Microsoft, Apple, and Alphabet, which is the holding company for Google. So the interesting thing about those three companies is they make up 10% of the total value of all of the stocks in the S&P 500. So just three stocks out of 500 stocks. And but they're also all in the tech sector, which is a little bit scary. So you've got three very valuable companies in one sector in the market. You know, there's 11 categories in the stock market, and of course technology is a very important category, but there's 11 to 10 other ones. So it is, there are some parallels here. The other parallel I was thinking about was 1999 with the dot-com stocks. But obviously these companies are more substantial than a lot of companies in 1999 were. And there's a couple of other companies like Amazon and Netflix and Facebook that you could add into that category, make up about 10 or 15 stocks. And they again, most of them are in the technology sector. And if you go out to 19 stocks like that, most of which would be in technology, that makes up 30% of the value of the S&P 500. And then, of course, you spread it out to the world, and you say, well, 53% of all the world value is in just a few U.S.-based stocks. So that creates an opportunity, which is what we've been suggesting in our practice, is diversify outside of the U.S. and diversify out of that one sector. And there's lots of good companies in Germany, Japan, France, all over the world. I know it's not popular right now, and I know it's a little bit more work to go and find which are the best companies. It's a lot easier just to buy that ETF. The symbol is SPY on the U.S. Stock Exchange. You can buy SPY, and you own all 500 stocks. Just remember, you're actually putting most of your money just in 19 stocks, not 500. But if you do a little more work or get some good help, you'd be better off to buy 20, 25 stocks and spread them all over the world, and make sure that you include a lot more sectors than just that one technology sector.
Well, today we saw a mini meltdown in the U.S. equity markets. Could more of the same be in store?
Well, it's interesting as we get all excited about, I'm just going to look here and see, the Dow went down 1.78% today. So it sounds like a big number, 372 points. It is a lot of points, but because the Dow is up so high, it's only it's not even 2%. So a major correction is usually defined as 20%. We almost had that in 2011. You remember when the U.S. government almost defaulted on their debt because they couldn't agree to pay the debt ceiling. So a 20% correction from here would be 4,000 points, I believe. Let's see. Yeah, that's right, 4,000 points on the Dow. So we did 300 a day, so we've only got 3,700 or 3,600 points more to go to get to that 20%. But we haven't had a 20% correction for so long now. It's been more than 8 years. It's one of the longest stretches without a 20% correction in the last 200 years that unfortunately, we're kind of overdue for one. So that, again, would argue that people should diversify even beyond the stock market into other safer things like government bonds and things like that, so that they don't risk suffering the full extent of that correction. The corrections are good, though, for the stock market, because then stocks get cheaper, and then investors will be rewarded down the road if they buy when stocks are cheaper. But it is a very interesting time to be looking at investing, and just putting money into ETF at this point is a much riskier thing to do than people realize when they do it.
Hilliard, thank you so much for chatting with us.
Thank you for having me on your show, Jim.
My guest has been Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBethGroup.com. You're listening to HowStreet.com radio. If you have any questions for the show or our guests, you can email us at info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.